I look at some of my hurdles in my life and I think about the adversity that I've faced being a minority and the adversity that my parents have probably faced being an immigrant. And I think, man, what a blessing, because those are all opportunities for you to learn and develop and be able to withstand adversity. It's all practice.
Welcome to the American Dream Builder and Investor podcast, where our vision is to inspire busy professionals, especially first and second generation immigrants and Americans, to explore the state of the American dream in 2022 and beyond. That is the Trinity of Freedom: time, financial, and geography freedom. I'm your host, Missy Liu, and I have achieved financial independence, and I'm helping many others to do the same. I started out with $5,000 and have really built wealth for my family along the process. Now, I am on a mission to help hundreds of thousands of people like me to do the same.
Hi, everyone. Welcome to another episode of the American Dream Builder and Investor podcast. I'm your host, Missy Liu. Today, we have a special guest here, Omar Kasim. He's a serial entrepreneur in Northwest Arkansas, where I live as well. He also founded quite a few different companies, such as Quesos, Plomo and Quesadillas, both are restaurants, and he's also a real estate investor. We actually just recently featured him in one of our local meetups as well, with him being the speaker. On top of all that, he recently was inducted into the 2021 Fast 15 list by the Arkansas Business Journal. His entrepreneur journey has been published on PBS TV show Startup USA, Google's 2019 Economic Impact Report, USA Today, and on Access Hollywood. Aside from running his own business, he also speaks regularly to schools and corporate teams on the subjects of motivation and thinking entrepreneurially. He's also a lecturer at the University of Arkansas, Wharton College of Business. So that's the formal bio for Omar. And I learned a little bit recently that he also is a second generation immigrant. So I thought that was interesting. And when one of his speech and conversation he was presenting at the Northwest Arkansas commercial real estate meetup, he was jokingly saying that, my immigrant mentality or what I thought and how he led him to certain decisions. I just thought that's interesting. He's relatively young as well and has accomplished a lot from entrepreneurship and also real estate standpoint and just personal motivation. So I thought it'd be really nice for him to come share with us how his cultural upbringing has shaped him and how he has accomplished freedom. We talk about freedom a lot in our podcast about time, financial, and geography freedom, what he thought of those and lessons he learned along the way on those topics. So starting out, Omar, tell us about your immigrant story. And I know you're American, of course, and a lot of our guests are, but this immigrant mentality or background has perhaps served you in different ways in your journey.
Yeah, most definitely. Thanks for having me on. I come from a very diverse background. My mom is Peruvian, so she's from the country of Peru, and my dad is Pakistani. So he's Pakistani, and they met in Tulsa, Oklahoma, of all places. And so both grew up not necessarily poor, but not wealthy. And they came to the United States for hopes of better opportunity. And through one way or another, they both landed in Tulsa, Oklahoma. My dad was working as a dishwasher at Denny's. My mom was a waitress and a hostess at El Chico Mexican restaurant. And they just kind of met through mutual friends. And so as I started growing up in Tulsa, Oklahoma, we had everything that we could possibly need. But by no stretch were we wealthy, maybe lower middle class. And as I grew up, I started moving into another home and we started developing our wealth. But those foundational principles of being fairly frugal and just always taking everything, with, just hopes that, there's going to be more opportunity, but to really cherish what you have was a very important lifestyle that my parents lived. And so I've seen that translate to myself now with my businesses, but even throughout college, I felt like I was always the most frugal of my friend group for sure.
That's awesome. Yeah, I remember in the meetup we talked about living below your means. I think the lifestyle creep is for real when it comes to the pursuit of freedom, whether it's time, financial, or geography freedom. If you don't keep your goals in front of you, whether that's achieving those type of freedom or having certain level of impacts, it's real easy to have lifestyle creep. The next thing you know is you're just trying to keep up with your lifestyle versus pursuing the dreams that you wanted. Sounds like your parents, were mostly in the, I would say, W-2 employee area. What inspired you to get into the entrepreneurship? I think you studied entrepreneurship in University of Arkansas as well, and then ended
Yeah.
up lecturing it, and then taking, a lot of people study it, may not actually do anything in that space, and you actually did something in that space. What motivated you and guided you in this process?
Yeah, well, actually, my parents, though they started as W 2 employees, eventually transitioned into entrepreneurship. My dad got his start. He bought his first gas station really early on. I don't exactly remember when, but before I was born, I always found myself going to our family business. And so I grew up in a very entrepreneurial environment. I understood, the long hours and that aspects of the journey because I saw my dad constantly working. I would see my mom counting the cash at home, and we would go run around to all the banks and everything. And I grew up in a very entrepreneurial home and very, very heavy on the small business emphasis. And I've been very fortunate for that because as I have started my journey and gone down this path, I think that my parents can sympathize a lot with the struggles that I go through. Being able to balance family and the business, having to say no to a lot of opportunities because I was restricted to my business. The pursuit of trying to create greater wealth for myself and, maybe taking all of the money that I had to parlay it into a better opportunity. And again, living very frugally and below my means. I think that with other people, it may be hard to look at how I live and how I have lived my life. But to my parents, having gone through that journey themselves, they understand the process of what I'm going through and what I will go through as I transcend into this next level of entrepreneurship.
Yeah, the parents definitely make a big impact on how the kids grow up a lot of times. In this case, I'm glad their entrepreneur efforts made an impact on you. But when you got started, did you start with your own money, start investing, or was your first entrepreneur, let's say the bigger project like the restaurant, etc. You kind of started with your own money with food trucks, or well, what was that process like? I think your real estate portfolio, especially on the commercial real estate side, which we're talking a little bit as well, is I think a little over $6 to $7 million in terms of the value today. So that is, a good amount of accomplishment for someone, whether your age or just in general, that's being in a real estate, commercial real estate for the past 2, 3 years.
Yeah, for sure. My initial start came right out of college. I had saved some money. I actually had a college hustle. I was tutoring business law that people think of that and they're like, okay, so you made, a couple $100 here and there. I actually would make thousands of dollars a day doing business law tutoring because I figured out that students needed to pass business law in order to move forward through the business curriculum. And so there's thousands of students that would need assistance with this and they would be willing to pay, maybe one person would be willing to pay $50 an hour. But if people took group tutoring sessions and each of those people paid $20 an hour, I could walk away making between like $100 and $400 an hour, depending on the group sizes. And so I had generated some seed money from that. I also won a bunch of different awards upon graduation that gave me a couple extra thousands of dollars, but it wasn't nearly enough to be able to open a restaurant. I mean, restaurants are very, very capital intensive. And so through like the support of my family, as well as me raising capital from an outside investor, I was able to open my first restaurant. Nowadays, everything that I own is all owned, as far as the restaurants go, is owned by me and me alone. And so on some of the real estate, I have partners, for varying deals. Some of the real estate I own on my own, but that's kind of how I got my start.
Well, that's very smart, thinking about scalability in your tutoring classes and think big from that very first job, perhaps first few jobs that you took. So, with the restaurant business, you started raising capital. How was that process like? Talk because that is actually a very translatable skill from whether it's capital, whether it's restaurant, or going to commercial real estate, or other spaces like entrepreneurship in general, raising capital. What was that process like for you? In my
Oh,
experience, it was really hard to get started, but then it gets easier from there after the first and second deal.
yeah, most definitely. It was not easy, and it's very much so a difficult journey because you're going down this path and meeting all different kinds of strangers, stating your case and really believing and stating with full conviction of why you think this thing is going to be a great opportunity. And on the other side of the table, these people's like number one priority is trying to figure out why this is not a great deal. And so most investors are rather cynical in nature in the sense that, they don't go into a deal thinking, I'm going to do this, prove me otherwise, and I'll back out. It's more of, I do not want to get into this deal unless you can really wow and delight me and show that this is going to be a great opportunity. And so when you look at maybe real estate, it's a little bit easier to see the true value proposition of, you're buying a property for this, you put in this much money. If we sell it for this, you get this much return. It's a very simple equation. Restaurants are not that simple because the assets are essentially worthless upon the start. You really gain the value from the intangible assets of the restaurant, the operating procedures, the brand itself, and then of course the income that it spits out. But even so, restaurants on their own, so like a single restaurant or two restaurants on its own is not really worth anything. It might be worth, maybe 1.5 times EBITDA or something like that, which is not a lot of money when you consider the amount of revenue that restaurants bring in. And as you start acquiring real estate that, goes underneath the restaurants, or you buy a piece of real estate, lease it to you have two entities, a real estate holding company and then a franchise company or the operating company, and you start doing things like that, that's where you build a lot of value in the restaurant world. And so that was a lot more difficult to prove. Really what I had to rely upon, because I didn't have restaurant experience prior to getting into my first restaurant. I was just a kid that fortunately did really, really well in school. I had a 3.99 GPA. I graduated magna cum laude from the Walton College of Business, which is a top 25 business college, and so I had to rely on those merits to try to convince a potential investor that, hey, I don't know what I'm doing, but you can see from all of these things that I'm smart enough to where I will figure it out. And I have, to some extent, through this business plan, my key assumptions, and so on and so forth.
That's awesome. Thank you for sharing that. Sometimes at the beginning, you just have to rely on experiences, whatever that experience may be, to help prove to others that you can do better in the future roles as well. And, the real estate piece, and I don't think I mentioned this to the audience, that some of almost real estate is in the commercial real estate side, some is in the residential side, but they're all very centered around Springdale, Arkansas, which is in Northwest Arkansas. It's a fast growing metropolitan area. And he has a very interesting strategy on that in terms of how he picked where he's investing. And I don't want to steal his thunder. Omar, can you talk a little bit more about this commercial real estate piece, how you developed your strategies around it? And then I'd love to pivot back into the restaurant and how everything fit together as well.
Yeah, I think that overall, of course, there was an interest in commercial real estate, but it wasn't on my radar at the time. I wanted to get into the real estate business somehow, some way. And the most economical way that I could do it on my own and really mitigate my losses as far as mistakes that I would make came through single family residential. And so I bought my first property in 2020. I bought a little house off of Mill Street in downtown Springdale and renovated that. Actually, I'm sitting in it right now. I live here full time. And so I heard about downtown Springdale through various real estate investors that I really admired in the area, and found that this area was very interesting because it was an up and coming downtown. I mean, all of Northwest Arkansas is developing, but this was one downtown that had yet to be developed. The Walton family from Walmart was investing a considerable amount of money in this area, and many others were as well, because it was in what's known as an opportunity zone. And so for those of you that don't know what an opportunity zone is, long story short, it's a tax incentive that if you invest capital gains into a place that the government deems as an opportunity zone, you can receive tax benefits. The most beneficial one being that after 10 years of holding that investment, if you sell the property, you pay no capital gains on the future gains. And so, all of these different things really connected. I connected the dots and just realized, downtown Springdale is an area that I really want to get invested in. Capital is pretty cheap right now. So this is, again, during 2020 when, you were at near zero and sometimes 0% interest rates. And there was not a lot of people playing in this space. Northwest Arkansas, Bentonville and Fayetteville are the two more attractive markets, with Rogers being, right below those two markets. And so it always seemed that people would just kind of skip over Springdale and downtown Springdale in particular. And so for myself, I knew that I wanted to play a more long-term strategy, that real estate was not my main hustle. The restaurants are. And so I was going to let the restaurants be my income generator. And then I wanted to be able to put and deploy my capital in an asset that would have maybe could actually sustain itself. So it would be sustainable through its own cash flow as far as it servicing its debt, but it had high opportunities for appreciation. And so that's kind of the strategy that I've put together for downtown Springdale. But it all arose from me, gaining interest from just reaching out to people and getting an understanding of why downtown Springdale was the next place that was going to boom, and just getting involved in the game and learning more about the real estate world through single family homes.
Yeah, I think that's a very good strategy that where you pick the area that not only has appreciation potential but opportunities and also great tax benefits as well, especially assuming in the future your wealth is going to continue to grow and that can always be paying less taxes is always a good thing as your wealth grows as well. And if I recall, there was a mentor or someone that gave you an advice about, hey, look into Springdale. There's a lot of people, there's not as much competition there. I'm sure you received all kinds of advice from all kinds of people. What prompted you to take this specific action compared to the others?
Yeah, I actually had heard that from two separate real estate investors that I consider mentors on two separate occasions. And so, whenever I had heard that, that really started spurring my mind to think, okay, there's two different people that are saying the same thing. Maybe there's something to it. One thing that I always say, a mantra that I live by is, advisors give advice, but that's all it is advice. And it's up to you to do your own due diligence. And so, I'd heard, that this is the next hotspot. This is the next hotspot. But something about downtown Springdale, I was really interested in. And so as I started digging into it more, I found that the properties were significantly cheaper than in Bentonville or Fayetteville. And so whereas in Fayetteville, if I were to try to buy anything under $300,000 or $400,000, it would sell within hours. And then certainly if I tried to get involved in anything multifamily, it would usually sell 30-40% above what list price was. In Springdale, there would be properties that were sitting there for a considerable amount of time relative to the rest of Northwest Arkansas. They'd be sitting there for weeks or so, in some cases months. And it's, dilapidated real estate that's like right in the heart of the downtown, and so I really saw that as an opportunity for getting a deal. And I think that is a little bit what I referenced in my talk about, something about immigrants. We love to get deals, we love a good deal. It's like if there's someone that's offering something for free at the mall or like at a trade show or something, you're going to see like an immigrant like go over there and grab it, even if they have no use for it. It's like, well, whatever, it's free. And so for myself, I just saw downtown Springdale as an opportunity for really great deals. Now you pair that with the opportunity zone stuff. Whenever I had met another individual that is working heavily on opportunity zones, he has a fund around here named Shiloh Capital. This guy had quit his job as an attorney at a prominent law firm in the area to specifically work on only opportunity zones. And so when he was nerding out and telling me all there is about opportunity zones and why he thinks it's such a great opportunity, no pun intended, I listened to that, and I started doing my own due diligence. And I was like, man, this really makes a lot of sense. There's an incentive to deploy capital in these dilapidated areas, right? There's a time restraint on how long you have to be able to improve these properties, right? So it's not like people can buy and hold these dilapidated properties and not invest in them. Anyone that deploys money into an opportunity zone fund has a specific amount of time before the clock strikes. And if they haven't done the things that they need to do to meet the criteria of an opportunity zone, they forfeit those tax benefits. And, the elephant in the room is that, you had the Walton family from Walmart and the Tyson family from Tyson Foods all investing, I think it's collectively like $250 million over all the Tyson investments. It's probably closer to 500 million, with like their CTO office here and so on and so forth. For myself, that I don't consider myself a real estate expert. Some do. I certainly don't. But what I am really good at is understanding trends. And I just really saw that, there was a giant cruise liner, the SS Walton developing in downtown Springdale. And really, you didn't have to be a subject matter expert to know that if you bought and built property next to these 50, $100 million developments, your property is going to appreciate. And so I saw that as an opportunity to where, in the restaurant world, I have been burned before when it came to speculation. I drank the Kool-Aid with some real estate developments that it's like, oh, this is how this story is going to play out. And it did not play out that way. Unfortunately, I had at least connected to that. So I had to, bear the losses with the real estate developer, right? And so when you talk about speculation with a private developer, there's nothing that says that these people are going to be successful, right? And there's nothing that says that they have enough capital to be able to sustain themselves to where they hit that inflection point where, it starts trending upward. But with the Waltons and the Tyson family, a lot of what they do is not performa based. It's not for them to generate a return. They don't have budget constrictions like other people do. They're doing things more for the long term benefit of the area,
Mhm.
or the long term benefit of their moneymakers, which is, the Walmart or Tyson Foods. And so I felt a lot more sure about buying and developing property around and to support these developments that they were doing, because I would be willing to bet that in the next 10 years, the Walton family is not going to fall apart, or the Tyson family is not going to fall short on their debt obligations. So
Mhm.
all of these developments that were happening here were sure things.
Mhm. Yeah, follow the trend or follow the herd is a great way. You don't have to be a super mega scientist. Sometimes you see where Walmart is built, you see a few other like Aldi, Dollar Tree, and different stores being built there, and they flourish
Yeah,
great.
that's a really smart real estate strategy that a lot of startup restaurants actually use, is that, if you're a small emerging restaurant, and let's say that you're in the fast casual space, meaning that you are counter service, your food is between, let's say, $12 and $15 a person, you don't have to have a real estate broker on staff or a subject matter expert to figure out that if Chipotle puts a location here and Taziki's puts a location here and Payway puts a location here, that's probably a happening area, right? They've already done all the due diligence, all that on that. And that's all you need to know, is that, there's a lot of restaurant groups that their real estate mantra is literally, wherever there's a Chipotle, there's going to be our restaurant. If we see that there's a Chipotle there, we're going to go ahead and do it. And so, to your point, I had a small little side deal that I did. I had a couple condos in Dallas in Highland Park. And one, just having the address in Highland Park was attractive, that it's like you have that glamour from that zip code. But also it was walking distance to a Whole Foods. I bought the first one without even looking at the property. I just bought it. I just, made an offer, and then I showed up for closing, 2 or 3 weeks later. But I just knew that it was going to be a great deal because it was, one, the basis was good. I was getting a home run deal on it. It was a person that was unfortunately getting a divorce, and so they were trying to get rid of it. But again, it was right next to a Whole Foods, and so I knew if it was near a Whole Foods, more than likely that area, I didn't need to like walk the neighborhood and determine if it was safe or what the streets
Mhm.
were like and everything like that.
Yeah, same thing with Starbucks. A lot of times
Yeah.
we'll look at a property that's maybe like C plus or B minus, depending on how far away the Starbucks is. We're like, yeah, we can't say that for certain, but it gives us a layer of comfort. So,
Yeah. Yeah. I mean, Starbucks, they're not dummies. They know what they're doing. And so, I mean, Starbucks isn't they're not selling $2 cups of coffee. So, if they've got a demographic that they believe is willing to pay $10 for a cup of coffee or something, they're more than likely, if you redevelop a C property to maybe like a B or a low A, it'll pay off.
yeah, exactly. It's interesting, right? Like restaurants, like McDonald's, like they're not in the restaurant business, they're in the real estate business. So it's an interesting intersection. How do you see your business intersect with real estate? So far, a lot of what I've heard is you made some good investments, and most of them you rented out to. I think in the past, I heard you talking about to nonprofit, to residents, and maybe short-term rentals. Are you also buying a lot of the real estate for your own operations where you're not doing that because it's maybe more higher risk? How do you look at those?
Yeah, we've been unable to buy the real estate for our own restaurants, and the strategy that we have for the restaurants, and is in particular Plomo Quesadillas, which is the thing that we're looking to scale. We have two locations here in Northwest Arkansas. We're opening a third location in a very prominent area of Dallas, this neighborhood called Knox Henderson, which is where all the young professionals and development is happening. Those pieces of property are rather difficult to acquire, because you're not combating private investors, like private single member investors. My landlord in Dallas is a New York REIT that's publicly traded on the New York Stock Exchange, and so it's rather difficult to be able to compete with those guys. And so for the restaurants, our strategy is to focus on our volume and focus on our internal metrics for restaurant performance and really seek out high quality, high trafficked bar districts, for our quesadilla restaurant, because we primarily do most of our volume, Thursday, Friday, Saturday night between the hours of 8 p.m. and 3 or 4 a.m. And so, for us, the real estate that we're looking after or looking at, it's not feasible for us right now to be able to acquire that type of real estate. I mean, you're talking, downtown Houston, downtown Austin, very, very, very expensive real estate. Now, as we start catching our stride, and let's say that we're 5 or 6 locations in and we have the ability to raise some capital, or we're just able to cash flow it on our own through debt financing, as we start to move into more B markets, these suburb areas, that aren't like the prominent late night bar districts or entertainment districts of these major metropolitan areas, or more of the suburbs of where our former customers, our former guests, moved on to once they became, adults. And yeah, exactly. Then that's an opportunity for us to start acquiring and building our own real estate. But certainly that has been a strategy that I've seen others do, and it works out really well. It's just for us and what our value proposition is and who our clientele is, it's not feasible without raising a substantial amount of capital and being significantly in the real estate game. I mean, you're talking, not buying single tenant spaces. It's a syndicated deal that is more than likely mixed use with retail on the base, office or apartments on the top, $40-50 million deals.
This podcast is sponsored by Life Mission Capital, founded by me, Missy Liu, where my life mission is to help busy professionals invest well so they can focus on what matters. All my life, I was taught to study and work hard for my freedom, until one day I realized that unless I let my money work hard for me, I will always be trading my most precious resource, time, for freedom. Since then, we have also been helping our investors passively diversify into more than 1,000 units of recession and inflation-resistant alternative investments, such as multifamily, mobile home parks, short-term rentals, and more. Learn more with our free ebooks at lifemissioncapital.com.
Yeah. Yeah, I've seen some of those syndicated, they can get very intensive on top of all the other operations you have to worry about. It certainly is wise of you to understand that and understand that maybe for later part, but right now you get to leverage the other real estate stuff you do to kind of like, it's interesting, like your restaurant business is bootstrapping your real estate and then vice versa. So it's growing
Yeah.
very well with each other. Yeah.
Yeah. Now, that being said, what you can do is find a real estate partner, find someone like this New York REIT that is doing developments all across the nation. And if you have a really great relationship with that landlord where you're really performing in one of these locations, you might reach out to them, or they might reach out to you and say, hey, we're doing another development in Scottsdale, Arizona, or in Nashville, Tennessee. And we've got these spaces available. Would you be interested in pre-signing if we could strike a lucrative deal for you, either through, a lower base rent or higher tenant allowance or tenant improvement money, and so the goal of that would be to perform really well to where a landlord believes in your product, believes that you fit the story and the criteria of what their tenant mix looks like. And ultimately, if they have pre-signs and they're able to vouch on behalf of you through intangibles like reviews and things like that, where it's like, people love this business, people have heard about your business, but also dollars and cents, where it's like, hey, these people are pumping out X amount of dollars or selling X amount of quesadillas a day, that helps with their future developments, because it becomes way easier and simpler to be able to attract other tenants, because they're not having to start from scratch. They've got a base of maybe 2 or 3 tenants, and then they only have to lease another 4 or 5 spaces, as opposed to leasing the entire thing from the ground up.
Mm-hmm. Yeah, definitely understand the potentials, and nothing is impossible. It seems like this day is just knowing the right partners, like you said, whether it's a REIT partner or somebody else can help you take your business to the next level, and you can add value to them as well.
Yeah. And I always like to say, when it comes to relationships like that, don't be afraid to ask questions and then give them what they want. For myself and our partners, they don't know we're partners yet, but in my mind, I'm thinking that we're partners. We're going to do developments and stuff together. I'm always asking them, hey, what like what makes a tenant attractive to you, right? What would you like to see from me to perform? What are some deals that you've done in the past where you've used the same tenant across multiple developments? And they'll be very honest and transparent with you to say like, hey, we like to see this kind of volume. We like tenants that, do X, Y, and Z. And they're basically giving you the answers to the test. It doesn't hurt to ask the question so that way we can be prepared. Even in the part of raising capital, I've reached out to private equity firms just to hear, hey, what are some deals that you've done in the past for restaurants? What were some of their metrics? What do you want to see? What do you like to see, on the financials? So that way I can have that on the back of my mind. So if I decide that that's the route that we want to go, it's like, okay, we've got to have this much debt on the books or this little debt on the books. Maybe real estate is a good idea. Maybe it's not. We have to, pump out this much cash flow or this much revenue, so on and so forth.
Yeah. Yeah, especially those important conversations, usually not just done in one conversation. So it's good that you started the conversation early just to get an idea and work towards it. Because it usually requires multiple conversation impressions to strike a deal at the end when it's the right time. Yeah.
Yeah. It just like one question, like becomes a hydra and just like spurs off multiple and
Hmm.
multiple questions. So the
Yeah.
sooner you can get a start on that, the better.
Hmm. Definitely. Some of the things I've been curious about, and maybe others too, is, Omar, from our conversation, you like to take risks, but, what I consider to be somewhat calculated risks, because you buy into basis point fairly low from a real estate side, restaurant entrepreneurship, they all carry risks. What do you feel is the biggest risk you took, and how did you justify that risk in the process?
Yeah. I probably would say the biggest risk that I've taken to date has been I bought a 100-year-old school building in downtown Springdale, right on Emma Avenue, at an auction. It was a closed bid system. I had 4 days to do due diligence. The property diligence that I did do was me walking around the property with a maintenance employee on behalf of the school and the architect that I work with for my restaurants, and him just giving me the thumbs up or thumbs down as an eyeball test. And I had 60 days to close on that deal. And so putting together the financing for that was rather difficult, especially because that was going to be my first commercial property that I had purchased. And so going to banks, going to investors, and constantly getting shut down because they're like, you have no idea what you're doing, or you have no idea what you have. And really just taking each meeting as an opportunity to learn. So I put a lot of meetings that I knew I more than likely wasn't going to be working with these banks or these investors. And I put those meetings first. So that way they could tell me why I was
Practice.
crazy. Yeah. And so I'd learn from that. And then on my way to the next meeting, I had already figured out an answer for those questions, and so at the end of the day, I was on the hook for, you know, probably about $600,000. I only had to put 2% down. And so I had to put like, I think like 14 or $15,000, and I had it under contract at 635. And so that was a very big risk. And there was a point where I did not know how I was going to be able to get the deal closed. Fortunately, the school was running behind on moving out. And so I had called the school and I had mentioned to them, I was like, if you guys need an extra couple months, that's fine. I was like, we could do a short-term lease. I'm like, would it be easier? Why don't we just push the closing? And they're like, you would do that for us? I'm like, yeah, like, let's push it another like 2 or 3 months. And so we were able to buy ourselves 60 more days. And at
I
that
see.
point, I had found a person that was interested in the deal and also had a reason to invest in the opportunity zone stuff. So the caveat to opportunity zones is you have to have capital gains to take advantage of it, right? It doesn't do you much good if you're taking your hard-earned money that you've developed through your business or something like that to invest in real estate in an opportunity zone if you haven't created a capital gains event. And so I happened to find a person that, one, was really interested in old buildings, like just because it was something that fascinated him, but also they had a lot of experience in it as a result of past deals. And two, the guy was printing out money because he had, exited out of some partnerships with some of his real estate portfolio. And so he was sitting on huge tax liabilities. And so it really made a lot of sense for him to sign on as well. And so it all worked out, but, very much so it couldn't have. Now, that being said, my attorney and my accountant certainly were not very happy with me when I told them that I unilaterally did this deal without informing them, just because I had such a short amount of time to be able to get it done. But after they got done lecturing me and telling me why, I was crazy and everything, I very like calmly told them my thought process of how cheap I was able to get the property, what other properties sold for in the area. And so I knew that the land itself was probably worth what my basis was, which was 635. And so if anything, the 21,000 square foot building was icing on the cake. And then I'd also known that there were other people that were interested in the property that just didn't pull the trigger on it, that had immediately offered me significantly more than what I had the deal under contract for. So worst case scenario, I could have been able to assign it to someone else and wholesaled it essentially, or to make a quick buck. And so not to say that I knew what I was doing, because I sincerely did it, but I had a very, very calculated reasoning of why I thought it was worth the risk. And it's paid out dividends. I mean, now again, we bought the property at 635, and we've had, 7-figure offers, multiple on the property that we haven't accepted. And so, and then the development around us, is you've got the Walton family doing a development that's a $50 million development to the south of us. And then you've got a nonprofit organization, the Jones Center Family Trust, that's doing a 36-acre expansion on the north side of us. So we're smack dab in the middle.
Hmm. Yeah, that risky project, risky in quotation marks, right? Because you did do some high level math, and is that one of the most successful, profitable deals to date from a real estate standpoint?
Yeah, well, it hasn't been realized yet, so
But
who
if
knows,
potential.
but as of right now, yeah, I always say I've got three things that I do. So I've got my restaurants, my businesses that are very, very risky. And so I've got a kind of risky, but kind of conservative, which is the real estate. And so they're all buy and hold properties that are cash flowing. This is probably the most speculative property, but again, it was office ready. The school had already renovated it to be, because they were using it as an office. So at the very least, I could get it rented out immediately.
Hmm.
And I've got very, very low to no risk, which is like S&P investments, index fund investments. And so
In terms of potential
certainly,
liabilities, yeah.
yeah. So I always say that if I did nothing right on this risky thing, and it all went to zero, I would still be set for life with some of the decisions that I made with downtown Springdale, and in particular the school building. So for that, I'm really grateful. It feels like I am playing with house money when it comes to my life, because of the opportunities that I was able to take advantage of.
Hmm.
Now, that being said, we're still striving for more and we're wanting to build, but at least I know that I've got tangible assets that will ensure that I'll never go broke or my family will never have to worry about if we're going to be able to pay for, little Susie's college. I'm not going to name a future daughter Susie, but you know what I mean?
Yeah, yeah. Some of the key things I'm hearing is when you're taking risks, you don't have to figure out all the letters of the risks you're taking and A to Z. You figure out the major pieces and you kind of go depending on how much capital is involved. It's like think about the immigrant mentality with first or second generation Americans. You knew what you want to get when you get to another country, but you don't have to figure out where you have to live exactly, the house, etc. You don't have to
It's not
know.
important.
Yeah, exactly. And then the second thing that was interesting to me, we didn't cover it here, but like you didn't know how you're gonna get the money. That was the part. Luckily, you also had a part outside the partner. You also had financing, so you never know. I think one of the things you said is it's kind of like you lose 100% of the shots you don't take. You took a shot, in some cases you got lucky in quotation marks because one of the bidder didn't submit their bids. But you have to take the shots in order to get the shot.
Yeah, you're absolutely right. You don't have to know everything, and for it all to come together. I think that the two important things is you have to see like the opportunity of how far and how much growth can this generate, like how much money, how much returns can this generate, and then the other side is what is my exit strategy too. So that's something that a lot of people don't consider, and that's a lot of the time I am very like big about, like, oh, I took these risks and everything, and I act like I don't know what I'm doing. But secretly in my head, I've also calculated and counted every back door, every window, every possible exit, And so I think that's also very important is that, you can take a lot bigger risks if you understand that you can also be able to get out of it for some way, or some that you have some sort of a parachute, not a fallback plan, but at least something to where you can get out of it and not have massive repercussions.
Yeah, that's whether at the deal level, which we'll talk about exit strategies, and I always emphasize in our commercial real estate deals as well, multiple exit strategy. You feel like it's overrated, but it is so important. You don't think it's important until something happens. And the second thing what I love is, you have your bases covered with the commercial real estate. I think a lot of people are afraid to take risks because they don't feel like they have a cushion. Now you have a cushion, so you're able to take bigger risks. So it's all connected.
Yeah,
Uh,
for sure. Yeah. And I still live very frugally. I had actually sold a couple of pieces of property prior to the school building acquisition, and my restaurants were doing really well, thankfully. And so I was sitting on a good amount of cash. Now, I could have bought myself, a brand spanking new car, bought myself a house in a more prominent neighborhood and everything. But instead, I just decided to roll it over to the investments and poured every free dollar that I had in the school building so that way I could maintain my majority share in that school building. A lot of people, when they see me and they see my age, they assume that when they find out that I have a partner, that I may be a general partner that has no equity in the deal. And, I've got an equity partner that actually has all the upside. I'm just kind of the puppet, but what they don't really know is that I'm actually the majority owner of that property. And I have a considerable amount of money tied up in that because I full-fledged believed in it.
Yeah. Awesome. Well, thank you so much, Omar, for your time here today. Anything you want to say before we close the call, the podcast here?
I think as it pertains to, the topic of immigrants, you know, I'm a big believer in turning negatives into positives. And I think that historically people can sometimes view being an immigrant as a disadvantage, that you have to work your way up the ladder. You have to work twice as hard as maybe the majority because you're the minority. And I can sympathize with some of that. But in my life and what's worked for me is that I've always tried to lead into it. I've always been thinking that, yes, I'm a minority, but that also allows me to stick out. People remember my name. People don't always remember John's name, but people remember Omar because there's not very many Omars that they may meet on a regular basis. And for myself, I look at some of my hurdles in my life and I think about the adversity that I've faced being a minority and the adversity that my parents have probably faced being an immigrant. And I think, man, what a blessing, because those are all opportunities for you to learn and develop and be able to withstand adversity. It's all practice. There was a time that I spoke at a Springdale middle school or a high school, and there was a student that emailed me after, and she was like, "Hey, I'm a Hispanic female. I just want to know how you were able to get over the fact that you're a minority and do so well in the business world." And my response to her was, you shouldn't look at it as I'm a minority, therefore I'm behind. What you should look at it as is, this is a blessing because I'm, one, unique, but two, I've had to face adversity my entire life. So when you get to college and life starts getting hard, or when you get into the real world and life gets real, if you've been through adversity, then it's nothing new. When COVID happened, prior to COVID, I had lost my company through my investor. He had ousted me through a hostile takeover, ran the company into the ground. I bought it back and turned it around. And just when it became profitable, COVID happened. And so many would be like, oh my gosh, when it rains, it pours, right? But for me, in hindsight, I just think, man, what a blessing, because all of that time when I was clawing my way back up to profitability, I learned all these different tools and tricks that later became the top 5 things to do to survive COVID. I'd already made deals with my landlord. I had already gone on digital. I had lowered our overhead and flattened our company by being the general manager of all 3 of our restaurants. I was doing all of these things because adversity forced me to. And so, to summarize, as a minority, you should look at this adversity and the trials and tribulations that you'll face inevitably on a regular basis as tests and opportunities to train and develop yourself. And you have to look at some of the other people that aren't as privileged, that may be privileged in the grand scheme of things, as far as like they may have more economic status or more access to education and things like that, but they don't have access to adversity. And so when they get hit, they fall. For
Yeah.
someone that's been punched their whole life, it's just another day in the park, baby. So
Yes.
yeah, I'd probably close with that.
Agree. Adversity is one of the best education. Investing in yourself is always giving you the greatest to invest and returns on investment. So, yeah, thank you, Omar. To summarize, about That's one of the key things I love is about living below your means and taking risks, different levels of risks, calculated risks, and have some level of safety net that helps you even take more risks. And I love the strategy in your real estate and business, how they work together, and what you said about changing your circles and work with your circles. And the last piece about, use what you have to your advantage. So really appreciate your time here with us today. And what's the best way for our listeners to get in contact with you if they want to follow you or get in contact with you?
Yeah, I'm really active on Instagram. That's the only social media that I really use. It's at Mr. Kasim, Mister Kasim, Kasim as in Mary, not Nancy, Mary. And you can email me at omar@kasimventures.com. So Omar at my last name, Kasim, ventures as in business ventures, not an adventure, not like a journey. Omar@kasimventures.com.
Awesome. Well, link in the show notes as well. Thank you so much, Omar. And thanks again.
Yeah, thanks for having me. Have a great day.
Thank you so much for tuning in to the American Dream Builder and Investor podcast with me, Missy Liu. We hope you enjoy the tips and tricks that others have used to build their American dream and their trinity of freedom. We would love for you to subscribe and leave a rating and a review. You can also find all the episodes and details on lifemissioncapital.com. Until then, let your life mission go wild.